Okay, so we're going to talk today about family installment sale planning, but I want to just go over some basic things here. The estate tax exemption today is $11,700,000 a person. So if you have a married couple, you could pass about $23 million right now. And the gift tax exclusion is also 11,700,000. So you could gift Ken and I $23 million right now if you're a married couple and you're wealthy and you like us. So that's a great opportunity. Now, Bernie Sanders would reduce the exemption to 3,500,000, and he would reduce the gift tax exclusion to 1,000,000. Now, do we think that's going to happen? It may happen in 2026 when both numbers would continue to go up with chained inflation, but would be cut in half January 1, 2026. That's what the law says. We're pretty confident something will happen before then in the shape of a compromise. Now, will that be a $5 million exemption for death and a $5 million gift tax exemption, or will they close that gift down to $1 million because they don't want you to be able to transfer appreciated property to your children who are in lower tax brackets, or will there be a tax on death? We don't know, but we know that these are available now. So to not use these now is potentially a terrible waste. Now, how much notice will we have if there's a reduction? The answer is we don't know. The worst case scenario, I think the reasonable worst case scenario is that the House Ways and Means Committee issues a proposed bill approved by the majority members of the House Ways and Means Committee, the Democrats there, which reduces the exemption, reduces the gift tax exclusion, and makes it effective the day it comes out of the House Ways and Means Committee. That's the worst case scenario. So it's better to get this done now rather than later. But what we are doing a lot of is setting up or further funding irrevocable trusts that are out of your estate for estate and gift tax purposes, but considered to be owned by you for income tax purposes, because then you can pay the income tax on the income, which isn't considered to be a gift, and you can sell assets to that trust at reasonable, low, sometimes discounted pricing, and in exchange for very low interest promissory notes. And over time, that will have a bigger impact than what the gifting does. So just wanted to kind of mention these things. Now, if you want to see the video where this literacy test came from, send me an email and put literacy, and I'll send you a link to the video where we reviewed all this. But here, you would have a couple of spouses. They may live in Florida. Spouse one may set up a lifetime bypass trust for spouse two and may put $1 million in that trust as a gift. And then that trust is not going to be subject to estate tax on death because it doesn't belong to spouse one. Spouse two could be the trustee, have the right to receive what spouse two needs for health, education, and maintenance, but it's not in her estate or his estate. And then spouse one may put $20 million into a family limited partnership and sell the 99% non-voting limited partnership interest to the trust in exchange for a note. So here on page 23 is what a client age 73 can do with a trust. So imagine this client has a $50 million net worth, has not given all his assets to Ken and me. So, and he sets up an irrevocable trust, could be for his spouse, could be for his descendants, could be for his spouse and descendants. And then Ken, do you want to go ahead and explain what this client could do with this trust?
That it was less than 3 years, we could use an interest rate of 0.12%. And what you see below that is that if the note ballooned between 3 and 9 years, we would be able to use a 1% interest rate. And below that, if the note was longer than 9 years, we would be able to use a 2.07% interest rate. Now, one thing to note, didn't mean the pun. One thing to point out is that if you are looking into doing a sale, you're able to use the applicable federal rate for the month of the sale or for either of the 2 prior months. So in this example, if we were looking at a May sale date, we would be able to look at the AFR for May, as well as the AFR for April and the AFR for March, and be able to pick the lowest of the 3 based on the applicable rate and the term of the note, so that we have more of the growth in the trust and less of the payment coming back to the client. Now below that, what we're showing is the opportunity to use a SKIN, which is a self-canceling installment note. And with a self-canceling installment note, the general rule is that if a client has a better than 50% chance of surviving for a year at the time that the transaction is entered into, most practitioners think that you could still use the normal rates to determine the value of a SKIN. Now, the IRS came out with a case called Davidson, which challenged whether we could use the regular IRS rates and assumptions when using a SKIN. And the question in Davidson is whether we need to use more of a fair market value to take into account the actual health of the client and the life expectancy of the client. So that's kind of a little bit of an unclear area right now. But with a SKIN, when you sell a note and you take a SKIN back, the benefit of a SKIN is it's a self-canceling note, as the name says. So any principal or interest that's owed to the client on the death of the client is essentially forgiven. It vanishes. It's not included as an asset in the estate of the client. So if we go back to the promissory notes that we showed above that, those promissory notes, the actual principal owed on it and any interest owed on it would be included in the client's estate for determining their estate tax exposure. With a self-canceling installment note, the SKIN, on the client's death, the value is 0. There's no additional payments that need to be made by the trust. And so to take into account the risk that the client might die before the payments are actually made, the IRS requires that we charge either an interest premium or a principal premium. So we could either mark up the principal from say $1 million to $1.4 million, or we could have to increase the interest rate. So in this situation, even though a normal 9-year plus note would be at 2.07%, if we were using a SKIN for a 12-year note, it would be at 6.587%. So the interest premium here is about 4.5% per year. And that's what is required to be charged because of the fact that you might not have the repayment of the entire amount back to the client. Now, one thing to note with the SKIN is that generally the term of the SKIN needs to be, well, if you're using commercial software, the term of the SKIN typically has to be for the life expectancy or less than the life expectancy of the client. You can actually go and do manual calculations if you wanted to have a SKIN that's longer than the client's life expectancy. But generally you would have to calculate that yourself, but it is something that could be done as well. The last couple items that we have here, one is a private annuity. So the private annuity has an annual payment for the life of the client that's owed back to the client from the trust. The benefit of the private annuity is that on the client's death, there's no additional asset that's considered to be owed to the client, so the client's estate does not increase, similar to the SKIN. The downside of a private annuity for some clients is that you have to satisfy what's called the probability of exhaustion test, which means that even though the client, is not expected to live to 110, the IRS requires that the trust have enough assets to make the annuity payments until on the assumption that the client would live to 110 years old of age. So for clients that maybe had done gifting in 2012 or sometime earlier that were successful in the gift and they have trusts that have a significant amount of capital in them, these trusts might be able to enter into a private annuity with the client that could be a great net effect for the client. But again, you need to have a trust with enough capital and assets in there to actually satisfy this exhaustion test. So the private annuity is a great technique to use. It's just, it might not be applicable for some clients depending on the amount of assets that are available in the trust. And then the last items that we have down below are what's called a GRAT. That's a grantor retained annuity trust. And with a GRAT, what would happen is the client would put in a certain amount of assets. In this example, we would have the client put in, say, $1 million worth of assets and would receive 3 annual payments back. And based on the IRS rates at the time in May, it was 0.8%, which means that the annual payments back to the grantor of $341,366 were the equivalent of receiving $1 million with a time value of money and discounts. So the grantor does not make a gift. The client doesn't make a gift by funding the trust with $1 million, the GRAT. And the client receives the 3 payments of $341 each year. And after the 3 years, whatever is left in the trust passes for the benefit of the client's spouse and or the client's children, and it's not going to be subject to estate tax in the client's estate.
Okay, very good. So to summarize a little bit here, for most of our clients, we will set up an irrevocable trust. It'll be a SLAT if the client's married and wants to benefit their spouse. It stands for Spousal Limited Access Trust, or it'll be a trust just for descendants. The client puts, in my example, $1 million into the trust as a seed capital gift. That's sort of that's the rule of thumb in the profession, I'll say, because there was a lawyer named Burl Abbin who had a conversation with an IRS agent when they were issuing a private letter ruling, and the IRS agent apparently said, yeah, 10% sounds good. And then that just became what everybody does. Professor Hesh and others believe that you could seed capital much less than 10%. Some people think you could seed capital only $5,000 and do a multi-million-dollar sale using guarantees. So, you know, it all depends on the circumstances and the risk and reward situation. But in any event, going back to my example, he puts $1 million in the trust, and then he puts $15 million into a limited liability company. He waits 30 days, and then he values the 99% non-voting member interest in the limited liability company, which has 15 million worth of stock. And a valuation report may say that that is worth $10 million, even though on liquidation it would be worth 15. Maybe it's worth 10, maybe it's worth 11, maybe it's worth 9, depends on who you ask. He sells that 99% non-voting member interest in exchange for a note. Now, the note usually is not longer than the life expectancy of the client. So if the client is 60, the life expectancy is probably 25 years. It might be a 20-year note just to play it a little bit safe. Interest rate may be 1.96% if it's done in September or within 3 months of September 2021. And so what's happening? Well, $15 million worth of assets are inside this LLC, outside of the client's estate for estate tax purposes. When that 15 million of assets doubles in value to 30 million, what does the client have? Still only has a 20-year 1.96% promissory note, which is only growing. If it's a $10 million note, then he's getting $296,000 a year, even though after 10 years there's $30 million, and he's only got $196,000 a year plus 10 million. Now, what happens if he thinks that the estate tax exemption is going away? Forgive the note. Just forgive the note. And that looks less sexy on a gift tax return, probably less likely to draw an audit to say, oh, I gifted a 10 million note, versus, oh, I gifted 99% of a limited liability company that had 15 million in it. Which would you be more likely to audit if you were the IRS? So that's the oversimplification, but some of the practicality here. Now, if the client is in good health, I'm probably not going to do a self-canceling installment note, because then instead of growing this estate at 1.96% of $10 million a year, I would be growing it at 6.587%. So instead of $196,000 a year, this client would be getting $658,000 a year. Now, If she spends that much, it might be okay to do a skin. Or if she has a short life expectancy. If she has a short life expectancy and you can be pretty sure that she's going to die within 12 years, then the skin is a great deal. If she dies in year 5, she's received, an extra $1.5 million in payments because of the higher interest rate, but the whole $10 million is out of her estate. The IRS is really serious when they say that you shouldn't do a skin unless you're in reasonable health. That Davidson case was very scary. It was a very large case. I think it was a couple $2 billion sale. Mr. Davidson owned the Detroit Pistons. I think there was Detroit Piston stock involved. So it was a high profile case. It was settled. Now, you can use the standard life expectancy table for a private annuity, no doubt about it. So if your client has a form of cancer where the life expectancy is normally 2 to 3 years, you could definitely do a private annuity. So he puts $10 million into the trust, and the trust pays him $897,000 a year for life. Or you could use other assumptions. You could say no payments for the first 10 years, and in year 11, and then you just run the numbers. We hire Professor Hesh, and he runs the numbers for us. Or we could learn to do it ourselves, but we forgot how, so we just let Jerry. And that's what happened in the Kite case. Mrs. Kite sold her assets for a private annuity, and there were no payments for the first few years, and she died shortly after entering into the private annuity, and it was outside of her estate for estate tax purposes. And if you want to know more about the Kite case, you can go to YouTube and search Gassman Kite Annuity, and there's a delightful musical video with an actress who did a great job singing for the benefit of Mrs. Kite. So these are choices we have. Now, if you have a large installment note and you don't have it's not self-canceling, and you get a bad diagnosis, well, I always say call us first, call your family second. You get a bad diagnosis so that we can make the note self-canceling. Ken, anything to add?
The only thing maybe to add is when you were talking about making the gift tax return less appealing as far as having an audit. If the client has cash or marketable securities that he or she would be able to gift to the trust, that might make it even less appealing from an audit standpoint, in that if the trust was owed a note of 10 million and the client had 10 million of cash or marketable securities, that could be gifted to the trust and reported as a gift, and then the trust could then prepay the promissory note without having to even disclose the existence of the note on the gift tax return.
That's a great idea. That's a really good idea. By the way, the probability of exhaustion test, which for a 70-year-old basically says if you're going to sell 10 million to the trust for an annuity, the trust better be worth 20 million. That rule may not be valid. It's under a Treasury regulation. Larry Katzenstein has written a very compelling white paper and published it in a Heckerling proceeding, saying he doesn't think the probability of exhaustion rule should apply. So if this gets your client below the estate tax exemption, and they'll never have to file an estate tax return, and you can get an opinion letter from Larry Katzenstein that the probability of exhaustion test doesn't apply, then the private annuity sale may be the way to go. So I have a polling question, and this is not a for credit program, but sometimes we present this for credit. So we give polling questions, and then CPAs feel better. So the applicable federal rate is what we follow when we set a note payment. It's not considered to be a gift to have a low interest note, as long as it is at the applicable federal rate, which is published by the IRS. It's lower than market rates, and there's a short-term rate, a mid-term rate, and a long-term rate, which you saw here. And the correct answer there, of course, is all of the above. So Ken, I had a couple questions from viewers that I promised you would answer.
Go ahead.
Are we still comfortable that the eventual tax bill will not be retroactive to January 1, 2021? Ken, what's your thought on
I
that?
think we're pretty comfortable on that. You know, it's one thing for Congress to enact something tax-wise retroactive that's beneficial for taxpayers. It's another thing to enact something retroactive that could cause a trap for taxpayers that thought they were doing something without any issue when they did, based on the way the law was.
Okay. And then Ken, what do you think about transferring your skin from doing an intentionally defective trust to a new GRAT for asset protection purposes? Well, I haven't thought of that.
So I think, you know, under Florida law, if you have an annuity and it's a commercial annuity, you know, that's a protected asset based on Florida law. It's not 100% clear if I can if I can create a trust, a GRAT, and receive an annuity back from the GRAT, if that's going to meet that classification. I think we take the position that it does, and it seems like it should. So it's definitely, it certainly would be more protected in a GRAT receiving an annuity payment back than simply having a installment note owed to you. If the installment note's owed to you directly, yeah, I don't think that there's much from a creditor protection standpoint of an argument to make. But with a GRAT, that definitely would be a better argument. And we have slides later that we'll talk about using what we call a SCRAT. And this would be a combination of using a skin and a GRAT together. And the benefit of that would be that if the IRS came in and challenged the valuation that you used on the skin because of the Davidson case and tried to take the position that you made essentially a large taxable gift on funding because either the principal premium of the skin wasn't enough or the interest premium that was applied wasn't enough. We think that using this combination with a GRAT is a way to avoid you from making a larger taxable gift than you had otherwise intended. So you might not have the tax result that you were hoping for, but if the IRS challenges it, at least you're not going to be on the hook for a much larger gift than you thought you made and or owe gift tax on the gift that was made on formation.
Okay, so the next one is, do I think that these irrevocable trusts are useful if you're below the exemption? And the answer is absolutely yes, if you're going to be above the exemption. I mean, we have a lot of clients who are at $5 million net worth, but they're in their 40s. So you're going to keep saving. That's going to double twice. It's going to be at 20 million. So remember, at 7.2% rate of return, your money doubles every 10 years. So, and the exemptions may go down. So don't wait. It wasn't raining when Noah built the ark, and don't wait before you do this. So the next question, the person, you know, says, why are you doing these sales? Why don't you just make the gift? Well, you know what? If the estate tax goes away, and if they pass this law that says that on death, all capital gains get eliminated, get imposed, they could do away with the estate tax, and my clients may want their $10 million repaid. So, you know, that would be one reason to wait. The second reason is if you die with a note owed to you, and it's 18 years left on it, it's only paying 1.96% interest, we're not going to value that $10 million note at $10 million. It's going to be worth about $8 million on your estate tax return. So yes, I understand a lot of our clients are using the 11.7 million, but a lot are just making sales for notes, and then we're going to wait to see what happens. So I think we've covered pretty much the basics of the installment sale. And let me just show you one. Well, let's do a second polling question. So a sale to one of these grantor trusts is, one, non-taxable. There's no income tax when I sell assets to a trust that is disregarded for income tax purposes, and there's no income on the interest income. What happens is I pay the income tax on all the income under the trust. Secondly, are these popular? Yes. Third, as I said, no income on interest paid, and the answer there is all of the above. So Ken, you've got this graphic here. Do you want to walk us through a typical sale?
Sure. So what you see here is the current structure. So we have Jane Client, and we have Client Holdings LLC. Now, Client Holdings LLC right now is 100% owned by Jane Client, and Client Holdings LLC may be a investment LLC that holds marketable securities and other items. It could be a holding LLC that owns ownership interests in other partnerships or other LLCs, and we just consolidate them at the client holding level. And so what you see here, though, is we've structured Client Holdings LLC with 1% voting and 99% non-voting. And that's important for the purpose of the sale, because by structuring it with a voting and non-voting interest, we're able to take a discount on the sale of the non-voting interest, because the non-voting interest does not have control over the LLC with respect to distributions from the LLC or with respect to the management of the LLC and the investments of the LLC. So therefore, that's what allows us to take, what we often assume is roughly a 30% discount for the purposes of the math examples. And it may be a little higher, it may be a little less. It depends frequently on what the assets are under Client Holdings LLC. But that's the basic structure that we have on day one. And then, Alan, I think, if you can just move the slides, that'd be easier. So then, like we talked about, you create your trust. This is your intentionally defective grantor trust. The client's treated as owning the trust for income tax purposes, which means, again, that we're not generating any income as part of this planning that would be reported on the client's 1040. It's really no difference from the fact of if they did any planning or not. And then you have to make the seed capital gift to the trust. And this is what Alan mentioned earlier, that there's no written bright line rule. I think, like Alan said, that kind of the normal rule of thumb is 10% of the total value of what you expect to sell to the trust. So if we have a $5 million asset and we assume a 30% discount, then the 99% interest is worth a little bit less than 3.5 million. So we would want to have, typically, to be safe, you would put about $350,000 of seed capital into the trust. But again, as Alan mentioned, that's not a rule that I could point to in a statute. And if you have a client that wants to fund it with less, then there's arguments that could definitely be made that they can fund it with less than the 10%. And so then the next step is, again, now we're going to sell the interest. And so this is where you would enter into the sale agreement for the 99% non-voting interest, which would get transferred from being shown as owned by Jane Client, the Client Holdings LLC. That 99% interest would now go to the Client Gifting Trust. And we have material that we can get to later, or if we don't, you can review later. For clients that are making a sale like this, the assignment, if you are confident that you're not going to be in a situation where you may have a valuation adjustment, or if you have a valuation adjustment by the IRS, you're not going to be subject to estate or gift tax being imposed, then maybe your assignment reads that you're transferring a 99% ownership interest. The other option is what we call a Wandry style assignment. And the Wandry style assignment defines the dollar amount. So back to my example where I had $5 million under Client Holdings, if we take the position that the 99% interest is worth 3.5 million, the assignment would say I'm transferring 3.5 million of non-voting interest in Client Holdings LLC to the Client Gifting Trust. And it doesn't say the actual percentage. Now the assumption is that it's 99% based on the valuation report that you received. But if the IRS came in and challenged the valuation report and said that really the 99% was worth, say, 4 million instead of 3.5, then effectively what happens is that you still transfer the $3.5 million interest, but that instead maybe it's a 90% interest instead of a 99% interest. So it's a way of helping to limit the exposure a client would have on the transfer for an indirect gift that would possibly cause them some issues from a gift tax standpoint. All right, and then the next slide. And so again, so this just shows that we've now actually transferred the 99% interest. And then now we have the note, which would be owed by the client's gifting trust. And again, you have all the options that we talked about earlier in the sense that this could be structured as a note that's less than 3 years, 3 to 9 years, more than 9 years. Typically, it's not going to exceed the client's life expectancy. You also have the ability, if the client wants to enter into the self-canceling note, the skin like we talked about. The other option is that if the gifting trust has sufficient funds, or you get that opinion letter that Alan talked about that the exhaustion test shouldn't apply, then the gifting trust could enter into an annuity back. So again, you have all those different options, and a large part of that we find for clients depends on what their cash flow is, what makes them comfortable. You know, they work their entire life to accumulate this wealth. So the one thing you want to make sure is that they're comfortable with their planning and don't think they're ever going to become a pauper, and that they're receiving enough of an income stream back to them. And one thing to note too that I don't think we've mentioned before is that if you have a promissory note owed back from the client's gifting trust to the client, we typically draft those as interest-only notes, and there is no prepayment penalty on the note. So if the client decides that the client needs, you know, some additional principal instead of just the interest payment, the client's gifting trust, the trustee of that trust, can make the decision to make the additional principal payment. Now, it is the decision of the trustee of the client's gifting trust. But one other thing to note is that the client can retain the ability to remove and replace the trustee of the gifting trust at any time and for any reason. Now, the client can't put a family member or an employee in as a trustee, but if the client had a family member serving as trustee and the client wanted to instead have Alan serve as trustee, and then the client could make that change, and then Alan would then go ahead and make the prepayment on the note. So that just gives you a little bit more flexibility to make sure that the client's comfortable with the income stream that they're going to retain.
Now, what if we put the trustee in Nevada? And the client get out of the estate and let the client have a back door back into the trust if
Sure. Yeah, so that's a great point. So if we create the trust in Nevada, or we have at least one of the trustees in Nevada, under Nevada law, you're able to create a trust that would be protected from your future creditors. Now that's a self-settled trust. It's something that's not allowed under Florida law. So Alan or I cannot create a trust that I'm a beneficiary of in Florida, which would be protected from my future creditors. But theoretically, under Nevada law, I could do this. Now, if I was a Nevada resident and the situs of the issue with the creditor was in Nevada, and it was a Nevada trust, then I think we would be fine there because we're applying Nevada law. The question is how effective it is from a asset protection standpoint. If we have a Florida resident, will the courts apply Florida law or Nevada law? And it's not 100% clear at this point. So the way that we typically would draft a trust is to say, if we say that Miss Client has a net worth right now of $10 million, and Miss Client is okay if she gets down to 3 million, but if she's below 3 million of net worth in the future because the sky falls, the market tanks, something happens, she has a creditor issue, etc. If she goes below 3 million, she'd like to be able to get access to the gifting trust. And so the way that we draft the gifting trust in Nevada is that the client on day one is not a beneficiary of the trust. So if she does have a creditor issue, the client can't point to the gifting trust and say that she's a beneficiary and therefore it should be unwound and they should have access to the trust. However, we have trust protectors who could put the client in as a beneficiary of the trust, but only if her net worth fell below that $3 million in my example. And the dollar amount is particular to the client. It's a decision that they can make. It needs to be a dollar amount that's less than their current net worth. But it's something that we can, it's fungible. Some clients it's 10 million, some clients it's 1 million. But that's a way of forming the trust in Nevada so that the client could be added at a future date if the client's net worth fell below a certain level.
Okay, very good. So while the note is owed, the payments are made, the LLC simply grows in value. If the client wants a couple million payment on the note, the LLC could make a $2 million distribution to the gift trust. The gift trust could prepay the note. Of course, 1% of the distribution would go directly to the client if they're the 1% owner. For those of you who are lawyers and CPAs, we typically do not have the client completely control all the voting rights of the LLC. We typically have somebody else separate and apart under a trust control the right to make liquidations and distributions from the trust, from the LLC. because of Internal Revenue Code section 2036A2 and the Powell case, which we could talk another hour on, but we're going to do a favor and not talk another hour. Want to also make sure that I remember to tell you that you don't just put the assets in the LLC and then immediately sell. You've got to wait because of something called the step transaction doctrine, or the IRS will take your discounts away. So we typically try to wait at least a month between the funding of this LLC and the sale of a 99% interest. So Ken, do you want to go ahead and show us Number Cruncher? And
Sure.
I know that this, well, let me just show you one example and then we'll go to Number Cruncher.
Okay.
So page 41, clients put $20 million in an LLC, married couple, spouse one sets up a spousal limited access trust, sells 49.9% of the LLC to the spousal limited access trust for a $7 million note, assuming a 30% discount. Other spouse does this for a trust for descendants. Maybe it's in Nevada, so it's reversible. Now you've gotten 20 million of value reduced to 14 million. And when it doubles in value to 40 million, all the client gets back is the interest on the note and the note. So you've taken $26 million out of their estate. It's a lot of drafting. It's a lot of paperwork. There's sale agreements, promissory notes, laundry clauses, irrevocable trusts, seed capital gifts. I mean, it keeps us busy and we love doing them. But the result can be quite impressive when this goes to 40 million and you have 26 million out of your estate and you've only made 2 million in gifts. You still have your exemption, so you could still do other stuff, you know, with that exemption that you kept.
And Alan, could we go back to that slide for 1 second, just to make one other note? Just if someone's wondering why we didn't do a spousal beneficiary trust for both clients in this situation, the IRS says something called the Reciprocal Trust Doctrine, which means that if I create a trust for my wife and my wife creates a trust for me, and they're essentially identical terms, the IRS is going to unwind that and treat it as though the trust that my wife created for me is owned by me for estate tax purposes. So you get absolutely no benefit from the planning of what you're trying to do here. So the reason we have a client's descendants trust on the right is that we would have one spouse create that trust, which would be only for the benefit of descendants. And then on the left, we have the more traditional spousal beneficiary trust, the SLAT, which could be for the benefit of the spouse and descendants. And that's the reason why we have the two different types of trust there, because it just doesn't work otherwise.
Yeah.
All right, so this is Steve Leinberg's Number Cruncher, and it is an amazing program. If you look at the left, and we're not going to touch on this too much, but this is just, it's amazing to me that they have this in here, valuation. It's a way of showing, you know, book valuation, estimating the capital, the goodwill. It helps you to get to that sweet spot if you're dealing with a sale between, you know, a purchaser and a buyer with respect to, you know, what the amount of goodwill is, where it could actually end up being less income tax for both entities, or both purchaser and the buyer. But the main thing to talk about, what we are looking at today, is if we look under, say, for the trust, for example, and we click on the IDIT, that's an intentionally defective trust, on the grantor trust, like we're talking about with an installment sale. And what they show here, in this example, we've used a 75/20 rate of 1.2, a 15-year term of payment. The gift in trust I put as $100,000 because that's the 10% of the sale. So I'm selling $1 million to the trust. And assuming a long-term AFR of 1%, which is what you would have for September. Further assuming growth of the trust assets at 5% per year. And what they show in the table here are the payments on the notes. Now the payments in this example are amortizing payments. They're not an interest-only payment with a lump sum on the end. So if you had a 15-year note, it would be amortizing $72,000 per year of the 124. And what's amazing on this is just, you know, assuming a 5% growth rate over the 15-year period, which is not very aggressive, I don't think, over a 15-year period. At the end of the 15 years, there's an additional $730,493 worth of assets that have been transferred to the trust. They're not going to be subject to estate tax. And one of the other big benefits is that because when you made the gift to the trust of the $100,000, the client would allocate his or her GST exemption to the gift and have to only allocate $100,000. But all that future growth is not subject to generation skipping transfer tax. So you've managed to leverage all that using $100,000 worth of exemption. You've managed to get $730,000. So you've managed to get an additional $630,000 worth of assets in this example out of the grantor's estate without using any of their exemption. So the table shows you the year-by-year breakdown. And then again, they show you the summary in the beginning with the future value of the remainder. And so again, the future value of the remainder is the $730,000, but in our example, we had made the $100,000 gift to the trust. So if you really think about the additional wealth on top of the $100,000 that was contributed or that the trust got, that's where you get the additional $630,000, which ends up with the trust having $730,000 at the end. So it's really just an amazing way to, to show that. And what's nice about it is that you are able to make the changes on screen. So if we wanted to make the sale to the trust for $2 million, and then it instantly updates. And you can have the option for the annual payments, which is what we would typically do. Some clients, because of cash flow, maybe they would prefer to have a semi-annual payment. You can determine whether the payment should be at the beginning or the end, and it adjusts accordingly. So it's really a nice feature to be able to show this, especially if you have a smart board or something like that in your conference room, and you have clients that come in and you want to show them different numbers and different assumptions. You're able to just change any of these rates. For example, if we wanted to use a different AFR, we could put it at 2%, and that increases everything accordingly.
Can you show us how skins work on Number Cruncher?
Sure. So if we go back here to where'd it go? There we go. So tools for estate planning on the left-hand side, we have skins. So fair market value of the property, we're going to say is $3.5 million. The discount rate 1.2. That's kind of a standard. It's updated based on what the applicable rates are right now. What's interesting about their program here is that you do have the ability to have recapture, et cetera. Now, for some of that would be if you were making a sale to a non-grantor trust. It wouldn't be applicable in our situation, because of the fact that this is all disregarded for income tax purposes. But if you were doing it to a non-grantor trust, you do have the ability to modify, which is really quite amazing, to be honest with you. They also give you the ability to determine if you want to have it on one life or on two lives. And so a skin can be on the life of the grantor, the skin can be on the life of a third party, or the skin could be on the combined life of the grantor and the third party. The one thing that you do want to be careful about is that if you are structuring a skin as a sale to a defective grantor trust like we're doing here, so it's ignored for income tax purposes, if it's not on the life of the grantor or solely on the life of the grantor, after the grantor's death, then there could be some income tax consequences because the payments are continuing and you no longer have a defective grantor trust. So that's one thing to just make sure you're aware of if you're looking through how to complete this. So in this example, at age 60, what I like about the software is it lets me choose, let's say I wanted to just do a 10-year skin, and we'll do it as an interest only, which again means we would have a balloon at the end. The other options that you have are level principal, meaning, obviously what it says, or self-amortizing. So if we stay with interest only and we go there, and that's the way it would read, annual payments. And so what you see here is with a $3.5 million sale, if we applied the principal premium, it would increase the principal owed to $4,055,000. So it's a $555,000 principal increase. If we went with the interest premium, what happens is that instead of it being 1.2%, we have to charge an interest premium of 1.56%. So our interest premium would be 2.761% with a $3.5 million note. And then this shows you again the value of the payments that need to come back, or the balloon note at the end. And again, this shows you with the total interest and capital gains, it gives you the option of if you were selling to a third party or to a complex trust, which is not I mean, there certainly are good reasons to do this, and it's great to have the software that could show you this. It's just not something I think that most clients typically would do because they're not trying to increase their tax liability by entering into the estate planning.
So
Um,
Ken, where do you determine the life expectancy to know when the note has to balloon?
And so what's interesting about what makes it even easier, I think, than some of the other software programs is for some of the other programs, and they do have the ability to determine life expectancy under, I forget where it was, I apologize, but they do have the ability to show you what the life expectancies are. But for a 65 or 60-year-old, the life expectancy is 24 years. So if I went and said I wanted to make a 30-year note, it automatically kicks me back to 24 years. So I don't have to go the second step of trying to determine what the life expectancy is. I mean, if I want to know it, I can get it and it shows that, but it automatically defaults to the maximum amount of years that it could be if you want to stay under the life expectancy, which is a great way for the program to work.
Can you show us a 74-year-old?
Sure. So if we did 74 and term of the note, so 13 would be the length, the longest that I could go. So if I tried to put 20 in here, it still kicks me back to 13.
And now I see the interest rate is 7.33%.
Exactly. So with a 13-year note for a 74-year-old, you'd be at 7.33%. With a 60-year-old at 13 years, we would be at, again, just down at 2.97%. Now with a 60-year-old, if we went out to 24 years, which is the longest we could go, the interest rate's 4.11%. So as you get older, the interest rate will go up. But again, with the 70-year-old or 74-year-old rather, oh wait, nope, not 109. Sorry, hold on one second. User error. But if we went with a 70-year-old, let's say, and the term of the note, so a 70-year-old could be a 16-year term, which would be 6.045%. If we decrease that to, let's say, a 10-year term, because our 70-year-old's been a smoker, has had a great life, and doesn't expect to live to 80. If we decrease that to 10 years, now we're down to 4.937%. So even though the note will balloon, 6 years earlier, if we're confident that the client's not going to survive the 10-year period, it's a way of saving a little over 1% per year of interest.
Okay, so we have about 2 or 3 minutes. Do you want to show us private? And by the way, you could put in 2 lives. So if it was a married couple and they want the note to continue until they're both deceased,
right,
you could put a second life, and that's going to move the interest rate down.
Sure. So in this example here, if we had a 70-year-old and a 65-year-old, and we did a 16-year note, the interest rate would only be 2.776%, which is an incredible rate for something like that.
Okay, so then what about a private annuity? Can you show that to us in a minute and a half?
Sure. So we have the private annuity here. Again, now this again shows you the if you are selling it to a complex trust or to a third party, it'll show you the actual income tax breakdown as well. But again, you don't need to worry about that portion of it if you're only selling to a defective grantor trust. So in this situation, if we were going to sell, let's say, $1 million of assets, and we had, we could say semi-annual payments with the payments being made at the end, and let's just make it a 1-person annuity. And then if we said they're 65 years old, if we wanted to defer the, like you said in the kite case, so if we want to defer the period for 5 years before the payments start, basically what you're looking at here is to sell $1 million with a 5-year deferral. The semi-annual annuity payment would be $45,630 per year, which is, so it's a nice way of calculating that. And now again, what they show you on the graph shows you the income tax aspect of it if you were selling it to a complex trust. So the graph could be basically ignored for what we've been talking about today, but it's a great feature to have, again, if you are in that situation. But this shows you then that, with a 65-year-old using a 20-year life expectancy, which is what they calculated, that, you know, you would be looking at basically annual payments of approximately 91 a year, but we collect semi-annual, so that's why we're getting it on a, you know, $45,000 every 6 months. And again, you could click on quarterly, monthly. It works out the same from a transfer tax standpoint, but it's whatever makes the client feel more comfortable. Some clients like getting that monthly check. Some clients are fine once a year. You know, it's whatever makes it easier and more comfortable for your client to be happy with the way the planning works.
All right, very good. Well, Ken, that was, I thought, a very nice example of how Number Cruncher works. And by the way, Ken and I don't have any financial relationship with Number Cruncher. We love the Lineberg organization, and we're always, you know, very happy to show off their products. So, want to thank everybody for attending here. Ken, any final words?
I think we've covered everything that we probably want to.
Yeah.
Hopefully we didn't put anybody to sleep.
Right. If they are asleep, they won't even know what we're saying anyway. But everybody, here's how you can find Number Cruncher. I don't know if you can, you can get a free prototype there and play with it by going to that link there on page 14. Hope everybody has enjoyed the presentation. We look forward to receiving your emails. Have a great day.